Look at your screen for a moment. See that spike? That thin green bar in the middle of the night? That is not volatility. That is a failed ambush. It is the moment a paper market that was built to sit on top of silver misfired in full view. And it is happening while almost everything else is pressed up near record highs. Silver sitting in the low 90s. Governments are drowning in debt, and central banks are quietly relying on inflation to melt that debt away. In the middle of all that, someone is still hurling tens of billions in paper silver into the dark hours, and for the first time in decades, those blows are being absorbed instead of knocking the price straight down. If your money lives in bank accounts, bond funds, or pension plans that promise safe yield while prices rise faster than your interest, that little green candle is not a curiosity. It is a warning about what your savings will actually buy 10 years from now. Behind that one bar is a simple 5-stage pattern that has allowed banks to use leverage to choke silver every time it tried to break out. For years, it kept the price pinned while real metal quietly bled out of Western vaults and into the hands of industry and long-term holders. What you're seeing now is the point where that pattern starts to fail in real time. If that failure spreads through a market that is already short of metal, the path to triple-digit silver stops sounding like a slogan and starts to look like basic arithmetic. And once you see how that works, you will not look at your portfolio or at that thin green bar on your screen in the same way again. That pattern is a loop the silver market has been running for decades, moving in 5 stages. Paper control, heavy futures, steering the quoted price, then inventory drain, metal leaving Western vaults, then premium inversion, coins and bars, trading above the screen, then algorithm failure, when sell programs in thin hours stop forcing the market lower, and finally repricing, short sellers trapped and the market jumping to a new level. We are no longer early in that cycle. The evidence points to late stage 3 shading into stage 4, where ownership changes hands the fastest. A standard silver futures contract on the CME controls 5,000 ounces, a mid-6-figure exposure at current prices. Yet a trader only posts a slices margin and effectively rents the rest, which lets desks unload thousands of contracts in seconds when trading is thin. Programs scan the order book, see shallow bids, hit the market with a wave of sells, trip stop orders, and force risk systems at other firms to exit. A chain reaction that on a quiet night can knock several percent off the price in minutes. This is not a theory. In 2020, a major United States bank admitted to years of spoofing in precious metals, paid a near billion-dollar penalty, and regulators called it manipulation. The tactics did not vanish, they evolved into faster, more complex algorithms. On the surface, the side with the most paper still seems able to dictate the tone as long as almost nobody asks for delivery. But in practice, that control only holds while the physical side of the market cooperates. And that is where the second stage creeps in. While traders watch the quotes, total demand from industry, investment, and other uses has run above mine output and recycling, leaving a shortfall of hundreds of millions of ounces. Mine supply has flattened near 800 million ounces a year, so the stocks built in easier times have been drawn down. Registered inventories on the large Western exchanges, the metal available to settle futures, have dropped by well over half since around 2020, and each big delivery shrinks the cushion under the paper market. At the same time, Asia has been pulling metal away from those pools. India, one of the largest silver buyers on the planet, brings in thousands of tons a year and is now estimated to account for roughly a quarter of global consumption. China is both a leading producer and a net consumer that still imports silver, and once those ounces arrive as coins, bars, jewelry, factory stock, or local funds, they rarely make the long trip back into COMEX storage. They vanish into long-term hands. Silver is not just decoration or an inflation story. It is a working metal threaded through the modern energy and data landscape. Solar farms, electric transport, and data centers burn through it because silver combines conductivity with reliability in a way cheaper substitutes struggle to match. Design workarounds can shave use at the margin, but each step away from silver trades efficiency and lifespan for short-term savings. When the price jumps, a speculator can step away from the screen, but a car maker or a utility cannot. They either pay the going rate or cancel projects. So when you hear about a structural deficit in silver, you are not just hearing about coin collectors. You are looking at the wiring of the green transition running through a metal whose visible inventories are already thin. That demand does not vanish because the futures price has a wild week. It keeps turning up in purchase orders regardless of what the chart claims. That is the second stage, vaults and warehouses running down while the quoted market behaves as if supply is endless. The third stage is when that denial finally shows up in prices. Stage 3 is where prices start to admit what inventories have been hinting at. In a healthy market, the futures quote and the cash price for coins and bars sit almost on top of each other, with only small gaps for tax, shipping, and dealer margin. In recent years, that link has frayed. In many countries, popular coins and bars have been changing hands at steady, sometimes steep premiums to the screen price. Dealers ask well above spot. Asian trading centers see buyers paying several dollars per ounce over the so-called global price just to secure metal. And at times the curve flips so that near-term delivery costs more than metal further out, a classic sign of strain. We saw an early version of this during the liquidity shock in 2020, when the quoted price of silver briefly sank into the mid-teens, while shops could not keep basic product in stock and premiums on ordinary coins jumped into double figures per ounce. What has emerged since is a quieter but more persistent version of that split. The premium is the market, saying there is not enough metal available at the headline price. That is the signal that draws in bigger players. Arbitrage desks and state buyers watch those gaps. When the spread between futures and physical widens far enough, they can buy contracts, demand delivery, ship the bars into a market where metal is scarce and sell at the higher local price. They keep the difference, and every turn of that trade pulls more metal out of the pools that back paper. That is how Stage 3 feeds straight into Stage 4. Stage 4 is what happens when the old playbook meets that kind of demand. You already know what a normal night raid looks like. Thin trading, a sudden block of selling, price dropping hard, and everyone waking up to a red chart. In a tight market, the same move can produce the opposite effect. Large buyers who understand the premium game leave bids resting below the market because they are happy to take metal at the artificially low futures price and move it to places where it will fetch more. When the selling wave hits, those hidden orders absorb it. The price stumbles for a moment, then lifts. The 1-minute bar that was meant to be a red waterfall closes green. What was supposed to be a smash turns into a small, short squeeze. From the outside, it looks like a strange spike that came out of nowhere. From the inside, it is simply an algorithm slamming into real-world demand that was never in the model. Stage 4 truly begins when that starts to happen often enough that it shows up in the risk reports. At that point, the people who oversee these positions at the major banks have to ask a hard question. If the raids no longer push the price where we need it to go, and the market keeps buying every dip, what happens if this keeps failing? From the bank side, this is where the numbers on the risk screen start to look more frightening than the chart. A large short position is not judged on what it might earn if everything goes to plan. It is judged on what it can cost if the market turns. That is what value at risk models try to capture. They feed in volatility, position size, past swings and correlations, and come back with a line a risk committee understands. A small stated chance of losing hundreds of millions in the next day. Now drop today's silver market into that frame. A futures arena where open interest towers over the metal ready to deliver, a physical side already short of supply, and a price that has moved hard and turned jumpy. If you or the person signed off on a very large short in that setting, every failed raid makes those model outputs worse. Because the next lurch up is no longer just a number on a report, it is a hit to capital and careers. A jump of $10, $20, or $30 in a thin market can trigger emergency calls for cash and meetings that run all the way up the building. Leverage makes it sharper. In futures, you only post a slice of the total value as margin, so when price jumps, your required margin climbs too, and risk staff demand more collateral. If you cannot meet that call, the exchange does not negotiate. It cuts your position at whatever bids are available. That is how a squeeze moves from unlikely to almost unavoidable. Not because crowds of small traders suddenly appear, but because the internal safety systems at big institutions decide the risk can no longer be defended. Once that starts happening in size, you are effectively standing in Stage 5. When you pull back, you can see who stands where as this pressure builds. Closest to the blast are the bullion desks and large funds running heavy short exposure. They are leaning on borrowed money and on patterns that used to behave, and in a market already tight on metal, each extra dollar higher is fresh marked to. Market pain. The software that tracks their positions does not log that as an opportunity. It flags danger to jobs and bonus pools. Further out, you find the industrial users, the solar makers, the electronics brands, and car companies. A spike in cost does not usually destroy them overnight, but it compresses profit margins. They can absorb the pain, try to pass it on through higher prices, or slow production. However they respond, the strain shows up in the real world as more expensive goods and delayed projects. Then there are the miners. On paper, they look like obvious winners when price rises. Revenue goes up, and their reserves look more valuable. In practice, most cannot suddenly double output. They are limited by ore quality, permits, investment cycles, and time. They benefit, but they cannot pour new metal onto the market fast enough to rescue the short sellers. People who hold physical silver, whether small savers or larger buyers, sit in a different spot. They live through the violent swings, the sudden drops and sharp rallies, but when the price finally resets, it is the metal in their hands whose buying power steps up. They are the least indebted players, with claims on the part of the system everyone else is leaning on. Furthest away are the quiet savers, the ones in bond-heavy portfolios or cash products that look safe while inflation quietly eats into them. They may never see or touch a silver bar, but their willingness to hold low-yielding paper in an inflationary world helps make the whole structure possible. In plain terms, the people with the most leverage and the least metal are first in line when the music stops. And the people with solid metal and little or no leverage are the ones watching the rules of the game shift in their favor. In any market where real supply is tight and a lot of money is betting on lower prices, the story narrows to two paths. Either new production arrives quickly enough to calm things down, or price has to lurch higher to choke off demand and force the short side to retreat. We have seen the second path before. In nickel in 2022, one very large short ran into a violent rise. The London Exchange halted trading and even canceled printed trades because the losses were too big for the system to swallow. In palladium and rhodium over the past decade, cramped physical markets and rising industrial use met limited mine output, and prices climbed in months to levels that had looked impossible a year earlier. And when moves like that begin, the rule keepers do not simply watch, they reach for a familiar toolkit. The first tool is to stop the tape. It might be called a circuit breaker or a pause for orderly trading. But in practice, it is the same thing, a hard stop so losses do not keep compounding in real time, just as we saw when nickel trading was effectively frozen while one blow-up was contained. The second tool is to change how much collateral traders must post. When prices run, the exchange can push margin requirements sharply higher in the name of safety. On paper, that sounds neutral. In a squeeze, it bites hardest into anyone who bought with borrowed money and cannot meet the new call, so they are forced to dump positions into a rising market. The third tool is to alter the rules while the game is being played. Products can be shifted into liquidation-only mode, new long positions can be capped, contract terms can be tweaked. None of that summons fresh metal, but it does decide who is allowed to stay in the trade and who is pushed out. If you ever watch all three tools pulled at once, pauses, sudden margin changes, and live edits to the rulebook, you're not looking at a normal pullback. You're looking at an attempt to contain a price level the existing rules cannot live with. Now set that behavior alongside silver. Silver is not a curiosity in one corner of the periodic table. It sits inside the wiring of industry and energy and also on balance sheets as a monetary reserve. It trades at the junction of factories, power grids, and savers, looking for something that is not another promise. All of that is unfolding against a wider backdrop where government debts are enormous. Central banks in major economies are under constant pressure to keep funding those debts affordable, and letting inflation run a little hotter than interest on savings has quietly become part of the toolkit. In that kind of world, shrinking the value of money over time is one of the few politically survivable ways to chip away at towering debt piles. Many critics describe that as a slow default on savers, a long transfer of buying power from people who hold cash and bonds to those who sit closer to real assets and real leverage. Whether you accept that label or not, the incentives are clear. Make the currency worth a bit less each year. Keep headline yields under control when you can, and let rising prices in the real world do much of the hard work. Markets respond to that regime in a fairly predictable way. Money looks for things that cannot be issued at will: land, energy, scarce metals, and in recent years, silver has been pulled into that search more and more. Set that alongside everything we have already walked through in silver itself: the strain on supply, the dependence of industry, the buildup of paper claims, and the fragility of the old control pattern. And you get a lot of space between where the price trades now and where it might need to go to reflect the physical world. One simple way to picture it is to look at the link with gold. If gold sits somewhere in the mid $4,000 range, and the market one day decides that silver should trade around 20 to 1 instead of roughly 50 to 1, you arrive at silver prices in the low to mid 200s per ounce. That is not a forecast. It is a thought experiment, a way to feel the distance between today's number on the screen and a level that would better match a tight contested supply. In that light, silver in the triple-digit range is not a fantasy on a message board. It is one plausible resting point, in the process of a paper market being dragged step by step into line with physical reality. If you are asking yourself whether all of this is just hype, that is a healthy reaction. Silver has hurt people before. It swings around, it can look like a circus, and it attracts loud voices. So let us deal with the main doubts head on. First, the idea that exchanges will simply lift margin again and crush any rally the way they have in the past. Yes, they can raise the amount of collateral traders must post when price starts to jump, and that move can knock out players who are stretched thin on borrowed money. But a real squeeze is driven by buyers who care more about securing metal than about squeezing every last ounce of leverage out of their accounts. They are better funded, they can pay the higher margin bill, and none of those rule changes add a single new bar to the vault. Second, the claim that the system can print endless paper silver and sit on the price forever. It is true that more contracts can be issued. It is not true that contracts can replace real ounces. When a growing share of participants insist on settling in metal, month after month, thin coverage stops being an abstract statistic and starts to show up as tightness and strain. Third, the belief that your country is different, that local regulators will never allow the kind of squeeze we have been talking about. Officials can tilt the rule book, they have done it before, and they can decide who's allowed to stay in a trade. What they cannot do is order mines to produce ore that is not there, or compel foreign holders and industrial users to ship their stock back at giveaway prices. Changing the rules can shift the pain around, it does not refill empty shelves. At this point, it helps to step away from charts and think about your own side of the ledger. If your savings sit mainly in bank deposits, in funds built on government debt, or in products that promise safety while yields sight, under the rate at which living costs creep higher, you are already inside the environment we have been describing. You do not feel it day by day, but over 10 or 15 years, the gap between the number you see on a statement and what that number will actually buy becomes large. That is why, quietly and often, without press releases, money has been edging into things that cannot be created at a keyboard, land, energy, and scarce metals. Silver's place in that shift is unusual. It is still wild at times, and it can be tiring to hold, but when you look at simple facts, tight inventories, strong industrial pull, and a price that still sits low relative to gold and to its own history, it remains one of the few big assets that does not yet reflect the full weight of the risks in the system. None of this is a personal instruction about what you should buy or sell. The point is narrower and more mechanical. If the pattern we have just followed on silver, from leveraged paper control to drained stocks to rising premiums to failing raids and forced repricing, continues to play out, then the noise in this market over the next few years will sit on top of something much larger. A change in how claims on silver are valued compared to the metal itself. That is the distinction worth holding on to. Finally, a practical note about this kind of material. It does not tend to float to the top of friendly recommendation lists. Platforms and advertisers are more comfortable with calm stories than with close readings of tape data, warehouse reports, and debt math. When we spend time on those things, the reach tends to be turned down quietly in the background. If you want work like this to reach beyond the small circle of people who go looking for it, part of that is in your hands. Simple actions inside the platform, tapping the like button while you watch, sending the link to someone who still thinks the quoted silver price is the whole picture, or leaving a short comment about premiums and delays you're seeing in your own market, all help to build a map that would otherwise never be drawn. Those actions cost you very little, and they make it harder to bury awkward facts. If you choose to go further and help fund research that is not paid for by banks, brokers, or bullion dealers, the support options under the video are how the data feeds, the time, and the production get paid for. That is entirely your call. The reality, though, is simple. If you want independent analysis to exist alongside corporate media, it has to be carried by viewers who find it useful, not by sponsors who find it comfortable. Here is the straightest answer I can give you. No one knows exactly how silver will move over the next year. There will be drops that make your stomach turn, sharp reversals that catch people off guard, and more of those two in the morning hits that look brutal on a short-term chart. But when you step back from the noise, the broad direction is not mysterious. Claims traded on screens still tower over the metal that could actually be handed across a counter. Deliverable stocks in the big vaults are far slimmer than they were. Factories and energy projects keep calling for more. Asia continues to pull large volumes away from Western pools, and major governments are running policies that quietly weaken their own currencies over time in order to live with their debts. In that kind of setting, silver deep into the three-figure range is not a certainty, but it is no longer some fringe fantasy either. It is one possible destination for a structure that has promised more paper claims than it has metal, while at the same time urging the world to use that metal faster each year. If you want to know where we really are on that road, do not lean on headlines. Watch a few simple things you can verify yourself. First, look at the reports from the exchanges and compare how much metal is listed as immediately available with the size of the outstanding positions resting on top of it. If the metal pool keeps shrinking while the stack of contracts stays large, the strain in the system is growing. Second, look around your own market. Check the larger dealers and the shops near you. Notice whether premiums edge up, whether common products are marked as back order more often, whether promised delivery stretches from a few days to a few weeks. That is the physical world speaking, not an opinion piece. Third, glance at the positioning updates. When you see the big commercial players slowly stepping away from large, short exposure while fast money leans the other way, you are seeing who is backing out of the danger zone and who is still playing near the fire. Those three checks, stocks, local conditions, and who is standing where, will tell you more about our distance from a real reset than any smooth explanation on financial television. All of it fits inside the pattern we have been tracing, from a market steered mainly by paper and leverage at the start, through the steady drain of metal and the rise of real-world premiums, into the point where familiar tactics begin to misfire and the quoted price is dragged closer to physical reality. Most people still think of themselves as living in that early stage, where the number on their app is the full story. You now know the process is further along. So I will leave you with this. What do you trust more, a price on a screen that can be nudged with orders, or the limits of a world that cannot conjure metal out of nothing, cannot wish away deficits, and cannot overrule supply and demand forever? However you answer, line your actions up with that answer. And if you are seeing signs of this where you live, higher premiums, thin shelves, policy changes, add them in the comments. The more real pieces we gather from different places, the clearer the outline becomes of where this path is leading. Thank you for watching, and please subscribe and like the video. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.